Okay, let's get started. We're going to be talking about break-even analysis and operating leverage. So, when we were doing, question? Okay. When we were doing payback, we talked about the amount of time to break even. Typically, when we're talking about break-even analysis, what we're talking about is the quantity to break even. And it sounds like a pretty simple thing, but we're going to see that it's not quite as simple as it might sound. First, let's talk about the two kinds of expenses. And this is oversimplified, by the way, because we talk about fixed costs, and these things remain the same regardless of how many units are produced. Now, fixed is kind of a misnomer because fixed costs could change year to year. So they're only fixed with respect to the fact that they don't change with the number of units we produce. And so let's set that aside and call those fixed costs. Now, what kinds of things are we talking about? The CEO salary, the rent, the electricity to keep the lights on. These are all fixed costs. And you can think about situations in your own life. You've got fixed costs and you've got variable costs. Your fixed costs would be your rent, probably your cell phone bill, and you've maybe a car payment. And then you've got variable costs that would change depend on how much beer you consume, how much pizza you consume, things like that. And so you can see the same thing in your own life. Then we've got variable costs, and these are ones that increase with increased production. And so they're usually zero when production is zero. So let's talk about the examples there. We've got raw materials. If we're not making anything, are we buying any raw material? No. Labor. If we're not making anything, now short term we might have labor if our business is down, if we don't lay people off. But typically the labor will move directly with the production. Now notice I've got an asterisk on fixed costs because I've already talked to you about the fact that they're not the same one period to the next. They don't have to be. And the other thing I want to talk to you about is the whole concept of fixed costs. Because when I was working in the oil field, our management had come from General Electric. And at General Electric, if you walked around with the words fixed costs on your lips, they would slap them out. And here's why. Because they said there's no such thing as a fixed cost. Because after all, can I fire a manager? Yeah. And so I could get rid of those costs. Could I sell a factory? Yeah, there are all ways that you could reduce that fixed cost. So instead of calling them fixed costs, they would call them long-term variable costs. So we had short-term variable costs and we had long-term variable costs. Now, GE is the only people I know that do business like that, and of course their progeny across all the companies that they went to. But I do want you to understand in your head that there are things that we can do about fixed costs, but it's just not in the short term. Does that make sense? It's kind of like you guys, you could move out of your single apartment in with a roommate and cut your costs. So your fixed costs would be long-term variable instead of being, say, short-term variable, unless you're just like month-to-month couch surfing on those couches. Okay, any questions so far? Nope, okay. Now let's talk about the concept of break-even. We've talked about in this class, and I hope you guys remember the day when I told you to write down the time and the date, and then I told you that the human race was doomed. Do you remember that day? What were we talking about? Contribution margin or marginal contribution. It is merely the price minus the variable cost per unit. So that's contribution margin or marginal contribution. Now, why is that important for figuring out what is our break-even quantity? And the answer is that in the beginning, when we just first start making whatever it is or providing whatever service it is, that contribution margin goes toward paying off those fixed costs. And then at some point, the number of units is such that the marginal contribution from those units is exactly enough to offset our fixed costs. And at that point, we have achieved break even. And so that quantity that is going to make the marginal cost multiplied by, or the marginal contribution multiplied by that quantity equal to the fixed cost, that's your break-even quantity. Okay, any questions so far? Can anyone tell me how to calculate marginal contribution? Price minus variable cost. Very good. Price minus variable cost per unit. And we've got to say per unit, and here's why. Because eventually we're going to be talking about our total variable cost, which would be variable cost per unit multiplied times the number of units. Okay, any questions? So, here is a very simple break-even example. Our fixed costs are $8,000. Our variable costs are $2 per unit, and each unit sells for $4. What level of production will result in zero profit? So, can anyone tell me what the marginal contribution is per unit? Yeah, it's $2 because we just take the $4 minus the 2. Okay, so we're going to say it's when sales revenue is equal to total cost. That's when we're going to break even. And our sales revenue, how are we going to come up with that? Well, it's the price times the quantity. Does that make sense? And we don't know the quantity here, so we're going to use the variable Q. So I've got 4Q over on the left-hand side of the equal sign. Now, my total costs are composed of two things. What are they? What two things do I add together to get total cost? Yeah, the fixed cost and the variable. So we've got our 8,000 plus, what's our variable cost? How much is our variable cost per unit? $2. Yeah, it's $2, and we're going to multiply that by this unknown quantity to come up with what our total variable cost is. And so our total cost is equal to fixed cost plus total variable cost. And so now I have one equation and one unknown. Can we solve that thing? Absolutely we can. And so we're just going to get it down to where we had Q on one side by subtracting 2Q from each side. And now we're going to divide both sides by 2 and end up with Q is equal to 4,000. So the break even is at a sales level of 4,000 units. Any questions? Okay, now let's see, it's not quite that easy. We're going to take it some further steps here. Turns out we can define this profit in 3 different ways, or at least 3 different ways. So we're going to have at least 3 different break-even measures. And the most widely used that you hear about, in fact, I went out and did a Google search yesterday, and when people talk about break-even, typically they're talking about accounting break-even. And accounting break-even is simply the level of production that makes net income equal to 0. Accounting production is simply, or accounting break-even is the level of production that makes net income equal to 0. But remember, we are finance people. We know that those accounting numbers, do they represent real cash flows? No. Do they give us any idea about wealth creation? No. What's the goal of financial management? Maximize shareholder wealth. So we know we want to be moving toward the idea of a break-even that helps us to maximize shareholder wealth. Well, the first step is to get away from accounting numbers and get to real cash flows, and that's when we talk about cash break-even. Cash break-even is simply the level of production that makes your operating cash flow equal to 0. Cash break-even is simply the operating cash flow, or the level of production that's going to make operating cash flow equal to 0. Now, cash break-even still isn't perfect, because it does not account for the risk of the project. It doesn't account for the risk of the project. And so that's where it brings us to the third one, which is actually the best one. And it's called financial break-even. And that's the sales level at which NPV is equal to 0. That's the sales level at which NPV is equal to 0. And I used to kind of skip lightly over financial break-even, but given that it's the most important one, what I want to do is use an Excel spreadsheet that you are familiar with and show you how we're going to get to that financial break-even. And so you may recognize the Baldwin project from last unit. And we have, in all of these periods, we have these unit sales. Now we're going to have to make a simplifying assumption here. And we're going to assume that the quantity is the same in each period. And what we're going to do is insert a line up here. And we're going to say quantity. And I'm going to start by just putting, say, 4,000 in there. And then I'm going to go down here and I'm going to say that my unit sales are equal to, I'm going to go back and reference that cell. And I want that to be the same as I copy it across. What do I need to do? Yeah, I got to hit F4 to put the dollar signs in. I'm going to hit enter. And then I'm going to drag that over. So there we go. So now we can roll down and we can see that that would give us a negative NPV. And you'll see as this thing gets higher, that your NPV also gets higher. In fact, now it's positive. But how do we get the exact number that will make NPV equal to 0? Have you guys ever used the solver in Excel? That's how we're going to do it. So, just in case you haven't done this in a while, you can see if I go to data, there's nothing over here. So, I'm going to say File, and I'm going to click on, I think it's more down here, Options. And I'm going to click on Add-ins, and I'm going to click on Excel Add-ins Go, and I'm going to click on Solver Add-in. And when I do that, the solver add-in comes up here. So I'm going to double click on that, and it's saying it wants to set objective B47, which is our NPV cell, set that to a value of 0. So that's actually what we want to accomplish. But it's guessing that we're wanting to change the rate. By the way, if we did that, what rate would it be giving us? What's the rate that makes NPV 0? Yeah, it's IRR. But we're not going to do that. We want to change a different cell. We want to go up here and change the quantity. And so now I'm going to say solve. It says it's found a solution. And I'm going to look at this quantity. 5,592.43 bowling balls. Can we have 5,592.43 bowling balls? No. How would I report this number?
5,593.
Yeah, it's got to be 5,593, even though that number rounds down. If we rounded it down, though, we would have a negative NPV. And so you got to round it up to have a positive NPV. And so our financial break-even for that project, assuming the same quantity every year, would be 5,593 balls per year. Does that make sense? Okay. So I am going to get back to our slides here. And first we'll talk about accounting break-even. And we've got some variables we want to define. Big P is the selling price per unit. Little v is the variable cost per unit. And we use little v because it's the per unit. Why do we use big P instead of little p? I have no idea. Q is the total number of units sold. And so therefore our sales is just going to be that price times the quantity. So that's easy enough. And then we have our variable costs. And in fact, what I'd like for you to do is write that VC is total variable cost. The VC is total variable costs. And the way we get it is by taking little v, the unit variable cost, and multiplying it by the quantity. Then we have FC, which are our fixed costs. And then we have D, which is depreciation. By the way, D is not included in fixed costs here. D is not included in fixed costs here. And then we have T, our tax rate. And so these are the variables I'm going to be using to talk about accounting break-even. And when we get to cash break-even, I'll use the same variables there. So, how do we figure this out? Well, remember that the definition of accounting break-even is the quantity that makes net income equal to 0. So what we need to do is have a formula for net income. Then we're going to set net income equal to 0, and we're going to solve that equation for Q. So how do we do that? Well, first of all, we know that our net income is equal to sales minus those total variable costs, minus our fixed costs, minus depreciation, multiplied by 1 minus the tax rate. Multiplying by 1 minus the tax rate just gives us our after-tax earnings, which is net income. By the way, notice, does interest show up here at all? No, we don't have interest in here. So we're talking about our variable costs, our fixed costs, our depreciation. Now we're multiplying by 1 minus t, so we're going to set our net income equal to 0. And so what we have here is 0 is equal to sales minus total variable costs, VC, minus the fixed costs, minus depreciation, multiplied by 1 minus t. Now here's a fun thing. Because we're doing accounting stuff, we can actually divide both sides by 1 minus t. What happens to 1 minus t? Yeah, it just totally goes away. It cancels out on the right-hand side. 0 divided by anything is still 0. And so we end up with just 0 is equal to S minus VC minus FC minus D. Now, we know we can substitute for sales. We know it's price times quantity. And we know that the total variable cost is the unit variable cost, little v, times quantity. And so I'm just going to substitute for S and VC. And by the way, if you've noticed here, I've also moved things around. I added FC and D to both sides. And so now, and the reason I did that is because what am I trying to do? I'm trying to get Q by itself. And the things in this equation that contain Q are the sales and the total variable cost. So that's going to end up on one side, everything else on the other. And so now we could, after we've substituted, we've got PQ minus VQ is equal to FC plus D. And so we're going to solve for Q. If I pull Q out of that left-hand side, what's left in the parentheses?
P minus V.
Yeah, P minus V. And so if I divide both sides by P minus V, then I get my break-even quantity. It's just the fixed cost plus depreciation divided by parentheses P minus V. What's another name for that thing in the parentheses on the bottom? Yeah, it's the marginal contribution. And so basically this is a fixed cost plus the depreciation divided by the marginal contribution is our accounting break-even point when the net, or where our net income is equal to 0. Now let me ask you this question. Is depreciation a real cash flow? No. Is it an expense we're really having to cover here? No, we've already paid that out, right? And so what we're talking about here is adding something on to the top that we really don't need, perhaps, in the world of finance, and dividing it by the marginal contribution. That means that the accounting break-even number is going to be higher. It's going to be higher as a result because not only are we covering the fixed costs, we're covering depreciation. Does that make sense? And so the highest of the break-evens that we're going to talk about, of the next two, of this one and the next one, is going to be this accounting break-even. Now let's talk about cash break-even. That's the quantity that makes operating cash flow equal to zero. So we know that this accounting break-even is a little funky because it's got depreciation in it, and we know we've got to add that back to get OCF. And if you look at the reading and if you look at any textbook, they always say we ignore taxes, and that usually rubs someone the wrong way. And so we'll get to what happens if we include taxes here in a little bit. But if we assume that there are no taxes, we know that we can take the sales minus the variable costs, minus the fixed costs, minus depreciation, plus depreciation. So basically, remember that the formula for operating cash flow is EBIT minus taxes plus depreciation. And so everything up to the minus D, including that, is your EBIT. And then there are no taxes, so there are no taxes to subtract, and then we add back D. What happens to the D's? They just drop out. And so we are left with the operating cash flow is equal to sales minus total variable cost minus the fixed costs. And we remember that we can substitute PQ for sales and little vq for VC. And we can also rearrange that stuff to where S and VC are on one side, fixed cost is on the other. And then that allows us to solve for the break-even quantity on a cash basis, or OCF is equal to zero. And that's just fixed cost divided by price minus the variable cost, which is just the marginal contribution. What's the difference between this formula and the accounting break-even? Yeah, just depreciation. If a firm has no depreciation, what's the relationship between accounting break-even and OCF break-even ignoring taxes? Yeah, they're going to be the same, right? Okay, now, as far as solving things on exams and homeworks and things like that, this is what I'll expect you to know. You know, it's interesting. In finance and accounting, we don't spend a lot of time talking about break-even, but I guarantee you when you get out in the world, you're going to hear it more than you heard it here at school. So let's do an accounting and cash break-even example, and we're going to do it with ignoring taxes. A new product requires initial investment of $5 million, depreciated to straight line to zero over 5 years. What is our annual depreciation? Yeah, it's got to be $1 million, right? Price is $25,000 per unit. That's little p, or that's big P. Variable cost is $15,000 per unit. That's little v. And additionally, our fixed cost, FC, is $1 million per year. So we've got $1 million per year fixed cost. We've got $1 million per year of depreciation. So the numerator for our accounting break-even is just $2 million. And then we're going to divide that by our marginal contribution, which is just the big P minus little v, the price minus the variable cost per unit. If I take 25,000 and subtract 15,000, that gives me 10,000. And if I take 1 million, if I take 2 million and divide by 10,000, it gives me 200 units. Now, how do we interpret that? It tells us that if we produce any fewer than 200 units, our net income will be negative. If we produce 200, our net income will be 0. And if we produce more than 200, our net income will be positive. Okay, now, remember we said cash break-even is going to be lower than accounting break-even because we're not burdened by that pesky depreciation. We can look at it here. It's fixed cost divided by marginal contribution. Fixed cost is $1 million. Divide by that marginal contribution of 10,000 gives us 100 units. So what's always lower, cash break-even or accounting break-even? Cash unless one thing. What could be true that would make them equal? No depreciation. No depreciation. So now we're on to operating leverage. And operating leverage, and you'll hear different definitions of it. When I teach this to my MBA students, the materials I use there talks about the number being EBIT, not being operating cash flow. Here we're actually using operating cash flow. But basically, it's some measure of profit. It's some measure of profit. And you may see it as net income, you may see it as EBIT, you may see it as OCF, but it's the same general idea. And this is the idea. Whatever our change in sales is, we're going to multiply that by the operating leverage, and that tells us our change in profit. Whatever our operating leverage is, we're going to multiply that by our change in sales, and that'll give us our change in profit. And so the higher the operating leverage is, the bigger the swings in whatever our profit measure is, based on the same change in sales. Did we talk about operating leverage in the last unit? I think we did. I think we did in chapter 12, right? Okay, so now we're going to get down to how do we actually calculate that degree of operating leverage using our fixed costs and our operating cash flow here. That operating cash flow in the beginning is merely trying to cover our fixed costs. And so if your operating cash flow is precisely equal to if your operating cash flow is precisely equal to your fixed costs, then we're going to add 1 to that. Let me see, let me try come at this from a different angle. What if our fixed costs are 0? What's our degree of operating leverage?
1.
Yeah, it's just 1. And let me give you an example of fixed cost is equal to 0. You've got a guy basically that sits and makes handicrafts at his kitchen table. So he's got his raw materials, he's got his labor. Does he really have any fixed costs associated with that? No. And so he's going to have fixed costs of 0, so he's going to have an operating leverage of 1. What does that mean? If he needs to increase his operating cash flow or whatever profit margin, profit measure we're using, if he wants to increase that by 10%, what does he have to do with his sales? Yeah, he's got to increase it by 10%. Well, let's assume that he has fixed costs that are equal to his operating cash flow. What is that second thing going to be? Fixed costs over operating cash flow. It's going to be equal to what? 1, right? What's 1 plus 1? 2. Now, if he wants to increase his profit or his operating cash flow by 10%, how much does he need to increase his sales? Actually, it's only 5%, right? It's only 5%. And so operating leverage sounds great when you're looking at increases in sales. So let's look at it the other way. What if his sales are down 5% and he's got an operating leverage of 1? How much would his profit be down? He's got operating leverage of 1. His sales are down 5%. What happens to his profit?
Down 5%.
Yeah, it's down 5%. Now, what if he's got operating leverage of 2? Sales are down 5%. How much is his profit down? 10%. And so operating leverage, actually we talked about how it goes into beta, but it's a lot like beta in that a higher beta sounds great on the upside, but it stinks on the downside. Operating leverage is exactly the same way. It's great when sales are going up. It's lousy when sales are going down. Now I want you to look at this formula though. OCF. Do you think OCF is dependent on the amount of stuff that we make? It's got P times Q in it. It's got V times Q in it. And so we know the more stuff we make, assuming our marginal contribution is positive, the more stuff we make, the higher the operating cash flow is going to be. So what does that mean? It means that the degree of operating leverage will actually be different at different levels of production. And so what we do is we figure out what is our degree of operating leverage for the current level of production, and then we can use that number to make some estimates of what's going to happen to profits as sales go up or down. So let's work an example. So we've got our previous example. We've got sales then of 300 units. Remember, the accounting break-even was 200. The cash flow break-even was 100. And so this 300 is well above both. So we know that net income is positive. We also know that operating cash flow is positive. We're going to ask, well, what is the degree of operating leverage at this sales level? And so what we're going to do is just calculate. We're going to start by calculating the operating cash flow. How do we do that? We're going to take that marginal contribution of $10,000. We're going to multiply it by the sales level we've been given, 300. And then we're going to subtract the fixed costs. And so that first part is 10,000 times 300 gives us 3 million. Subtract the 1 million in fixed costs, that gives us $2 million. Now, why does depreciation not show up there? Why does depreciation not show up? Remember we said we're ignoring taxes? So the only reason depreciation ever makes a difference to us from an operating cash flow perspective is through its impact on taxes. If we're ignoring taxes, then we don't have to worry about it. Okay, so our operating cash flow is 2 million. Our degree of operating leverage, therefore, would be 1 plus 1 million over 2 million. What's 1 million over 2 million? Yeah, it's just 0.5, so add 1, we get 1.5. That's our degree of operating leverage. And so what if we've got this degree of operating leverage, 1.5, and our sales go up by 20%? What happens to our OCF? Sales are up 20%, multiplied by 1.5. Yeah, OCF is up 30%, so that all sounds good. But what would happen if we were down 20% in sales? Our profit would be down by 30%. I think I used the example of Honda and General Motors when we were talking about operating leverage in the last unit. And you can see that when someone's got high operating leverage like GM, they do great when sales are up and they do worse when sales are down, versus Honda, who depended less on fixed costs, more on variable costs, so their operating leverage was lower, and therefore their swings were not as great. When times were good, they weren't up as much. When times were bad, they weren't down as much. Questions? Okay, that's the end of that set of slides. Let's turn that off. Next, we're on to tracing cash, operating cycle, and cash cycle. And I should have told you this to begin with. Remember, the 3 units of this class are based on the 3 questions we ask in corporate finance. There is the capital budgeting question, which is what we just answered in Unit 2. And then what was the question we answered in Unit 1? Say it again?
What's the goal?
Oh, no, that's the overarching
That's
theme
right.
for our entire lives. What are the 3 questions? Can anyone tell me one of the 3 damn questions? Mr. Stiff?
No.
No. I just got through telling you what one of them was, and you still can't regurgitate it?
No.
Yeah, the first question was a capital structure question. The first thing that we covered is the capital structure question. And that is the question of how do we finance the assets of the firm? And the one we just covered is the capital budgeting question, and that is what assets should we buy? Those are two separate questions. Don't let anyone confuse you as to those things being connected. And then there's the third question. What was the third question that we asked? I'll get you started. How should we manage the...
Assets you buy.
No. By the way, everything we've been talking about so far has been long-term. Does that give you a hint at all? Okay, we're going to have to write this down again. Today's date, the human race is doomed. Long-term and short-term. And what are the short-term things on the balance sheet? Current assets and current liability. What do we call current assets minus current liabilities? Yeah, net working capital. So the third question is this. How do we manage the short-term cash flows of the firm? How do we manage the short-term cash flows of the firm? And we call that the working capital management question. And I just explained to you why we call it the working capital management question. Because we are managing the short-term cash flows, and the short terms are current assets minus current liabilities, and then that's called net working capital, or just working capital. And so we've got capital budgeting, capital structure, and working capital management. Those are your three big ones. Now, which one of those, if you screw it up, is likely to kill you? Do you remember which question I told you at the very beginning was most important? No, of course not. Let me ask you this. If we don't take care of the short term, do we have to worry about the long term? No. So, undoubtedly this winter we're going to have some really cold weather. At which point you decide to run naked across the campus. What's going to happen to you?
You get cold.
You're going to get cold, and you might even get hypothermia and die. Now, your long-term plans of getting a job and finding a spouse and having kids, especially the kids part, who knows what might drop off. But those things are now in the dumpster. What's my point in telling you this story? If we don't take care of the short term, is there any long term? No. And so I always think that this third question is the most important, because if we don't take care of it, we really don't have to worry about what's going on in those other two questions. So this is perhaps the most important unit of the class. You might say that I should have put more weight on this exam than the other exams, but I won't. Okay, so what's our goal here for tracing cash and net working capital? We're going to describe the short-term operating activities of the firm, and we're going to show how they impact cash and working capital. And we always need to remember that current assets are things we expect to turn into cash within the next year. Now, is that necessarily totally true? Can someone give me an example, Ms. Griffin?
I don't know mine.
What's that?
I don't. Somebody else.
Yeah, she says I got the first part of it. Okay, so which one of our current assets are we least likely to think is going to turn into cash in the next year? Can someone just list the current assets? That's not a current asset. Inventory. Inventory. So inventory, first of all, when we sell inventory, do we typically get cash? No, we get what? Accounts receivable. And so not only do we have to sell this inventory, then we have to collect on the sale. And so that's we've got to take these things into account when we're trying to figure out what's going to happen to our cash. Now, what about current liabilities? Do you think that they're unlikely to require cash? Oh, hell no, they're certain to require cash, right? Your bills are certain, the money coming in, not so much. Questions? So let's talk about cash and the balance sheet. So we know that cash is a current asset. And we know that our net working capital is equal to current assets minus current liabilities. Bless you. And so we could say it this way. We could say cash plus other current assets minus current liabilities would be our net working capital. And so if we throw that into our balance sheet, but by the way, our balance sheet equation here, what is weird about it? We've modified it. How have we modified the balance sheet equation? Let's start by working with a very basic balance sheet equation. Can anyone tell me the balance sheet equation?
Assets equals liabilities plus equity.
Yeah, very good. Assets equals liabilities plus owner's equity. Okay, now we can break these things down even further. We could talk about current assets plus net fixed assets over here. Does that make sense? And we could talk about current liabilities and long-term debt. You got to add those together to get your liabilities plus your owner's equity. Does that make sense to you? Okay, now how could we change this thing to look like what we've got up there? What's net working capital equal to? Current assets minus current liabilities. So let's take, let's subtract current liabilities from both sides. So we end up with current assets minus current liabilities plus, in fact, what are they calling it here? Fixed assets, yeah, same thing. NFA is equal to long-term debt plus owner's equity. Does that look like what we have up there? Yeah. And then we said we could substitute for net working capital, this thing right here, that we could say it's cash plus other CA minus current liabilities plus the net fixed assets equals long-term debt plus owner's equity. Now, why are we going through all of this? We're going to be solving for cash, and then we're going to be using the signs on these other things to know how those things are going to impact the levels of cash at the firm. So when I when I get everything except for cash on the right-hand side, this is what it looks like. Cash is equal to long-term debt plus owner's equity minus other current assets plus current liabilities. Did I do that right? Long-term debt plus equity plus current liabilities minus other current assets is equal to cash. It looks right to me.
Fixed assets.
Oh, where did they go? Oh, yeah, we need to, I'm sorry, I need to subtract them to get them away from cash. Very good, thank you. Okay, so here's what this means. We can go through each one of these things and say, what happens, we're going to say cash impact here. What happens to cash if long-term debt goes up?
Increases?
Yeah, it increases. There's a plus sign in front of that. So, and it makes perfect sense. If you go out and borrow a bunch of money, what does it do to the amount of cash you have? It increases it. So if we're going to say long-term debt goes up, then cash goes up. What about owner's equity? What's the sign on it? It's positive. And so if owner's equity goes up, in other words, you issue a bunch of new shares and you receive a bunch of cash for that, then your cash is going to go up. Makes perfect sense. Minus other current assets. So if other current assets goes up, what happens to cash? Yeah, it goes down. And let's talk about why that is. So other current assets, we're talking about inventory. If I go out and spend some cash to acquire inventory, what does that do to my cash? It's going to go down, right? If I sell on accounts receivable instead of cash, then I am not receiving a cash that I would have otherwise. And so that's why these things are opposite. And then we have current liabilities. Current liabilities goes up. What happens to cash? What's the sign? Positive, right? And so as current liabilities go up, cash go up. Now, the easiest way to think about this is to think about it the opposite way. If current liabilities go down, cash goes down. Example, accounts payable. Accounts payable is a current liability. If you choose to go out and pay off your accounts payable, your current liabilities go down, but what happens to your cash? It also goes down. Does that make sense? Okay. And then, net fixed assets. As net fixed assets goes up, what happens to cash? Yeah, cash has got to go down. So think about this. If I go out and buy a new machine, what happens to net fixed assets? It goes up, but what happens to the amount of cash I have? It goes down. What if I go out and sell an old machine, after-tax salvage value, that's cash flow in, what would that do to my net fixed assets? Yeah, it's going to go down. So these things always are opposite. Questions? Okay, so I think we just got through basically covering that. There are some things here that we haven't talked about. I talked about borrowing additionally on the long term. If I pay off long-term debt, of course, that's going to reduce cash. So once again, opposite or same direction. We talked about issuing stock, but there is the opposite thing where we repurchase stock. If we repurchase stock, we know equity goes down, but what also has to happen to cash at that point? Yeah, it's also got to go down. Increases in our short-term borrow. So if we go out and buy a bunch of stuff on credit instead of with cash, then that preserves cash. If we pay off our short-term loans, though, that's going to decrease cash. We talked about that. We talked about, I don't know, did we talk about selling inventory for cash? We talked about buying inventory for cash, right? So we went the other way with it. And we talked about those last two things. So I think we've got all that covered. So let's talk about the operating cycle and the cash cycle. You're going to see that one of these is contained within the other one. The operating cycle is the number of days between the acquisition of the inventory and the cash from the sale of that inventory. And so I acquired the inventory today, the clock starts ticking, and that clock continues to tick until the day that I get the cash for that sale. Are we talking about the day that I sell it? Probably not. When we sell stuff in industry, what do we typically sell? Do we sell on cash? No, we sell on credit, and instead of getting cash, we have accounts receivable. And so we're going to have to put this thing into our inventory. We're going to have to wait till it actually sells. And then we're going to have to wait to collect the money before this operating cycle is complete. Does that make sense?
So would it just be the inventory period plus the accounting Or the accounts receivable or
Yeah, it's
receivable
the
period.
inventory period, and then it's going to be the accounts receivable period. Now, let's talk about the cash cycle. How does the cash cycle differ? The cash cycle is the number of days between paying for that inventory and collecting the cash for the sale of that inventory. If your suppliers insist that you pay cash, what's going to be the relationship between the operating cycle and the cash cycle? Yeah, they're going to be exactly the same. It's when suppliers offering us credit enters the picture that we start to have a difference between these two. Let's assume that I buy some inventory and I have to pay for it in 30 days. That cash cycle is then going to be 30 days shorter than the operating cycle. Does that make sense? Because I don't actually have to come up with the cash for that inventory until 30 days after it enters my inventory. Remember, operating cycle is working from the day that that inventory arrives and the day we collect the cash. The cash cycle is just from the time that the cash goes out for the inventory until we get the cash back for selling that inventory.
Did you say it's the same thing as operating cycle, just minus the payable period?
Oh, very good. Yeah. In fact, that's what our next slide is going to show us. So, on the top, we have the operating cycle. And that operating cycle is, just as he said earlier, inventory period plus the accounts receivable period. Now, we have names for these things that we've been able to calculate in your previous classes. The inventory period, we would call that what? Days sales in inventory? And it would be 365 divided by inventory terms. And then we've got our accounts receivable. That would be days sales in receivables, also known as the ACP or average collection period. So these are things that you guys hopefully have seen before. Have you seen these before? Good. Okay, if I add those two together, that's going to give me that operating cycle. But what about the relationship between that and the cash cycle? The only difference is going to be that accounts payable period, because for that period, I'm not having to pay cash for that inventory. And so in the traditional example, therefore, we end up with our cash cycle being shorter than our operating cycle. For purposes of keeping your business alive, which do you think is more important? What happens if you don't pay your bills? You go bankrupt. If you go bankrupt, the company is, at least your management of the company is basically done for, right? So, what do we use to pay those bills? Cash. I'm going to ask you one more time. What do you think is more important number for survival of your firm, the cash cycle or the operating cycle? Yeah, the cash cycle. Man, if I could talk my suppliers into giving me 90 days terms, whew, I could lower my cash cycle. My life would be a whole lot easier. Does that make sense? So here we have a table of different days when things happen. We acquire that inventory on day 0. Bless you. And because we did not pay cash for that inventory, there is no cash impact then. Then on day 30, we have to pay for the inventory. And so we have a cash outflow at that point. In this example, it's $1,000. And then on day 60, we sell the inventory on credit. What does that do to our cash? Not one darn thing, right? We don't get cash until we collect that receivable, and we collect on that sale on day 105. And we collect $1,400. Now, let's make the assumption that everyone in this example is paying on time. How many days are our suppliers giving us to pay? 30 days. How many days are we giving our customers to pay? 45. Does that sound like maybe we could do better there? Yeah. Now, here's what you need to know about terms. Terms that people expect vary by industry. In some industries, it's all cash, no credit. But whatever industry you're in. So the raw material providers, the industry that they're in, maybe 30 days is standard. But the people buying my finished products, maybe in my industry, 45 days is standard. And so just because these are different doesn't necessarily mean we have a problem. Questions? So how long is our operating cycle here?
105 days.
Yeah, it's the full 105 days, right? From the time we put it in our inventory till the time we get the cash at the end, 105 days. But when we do the cash cycle, all we're doing is subtracting that accounts payable period, which we said was 30 days. And so 105 minus 30 brings us down to 75 days. And just as we predicted, our cash cycle is shorter than our operating cycle. Now I want to go back to this and tell you something that it was freaky to me. So when I used to work in this machine shop down on the Gulf of Mexico, and we were basically what was called a hot shop. In other words, we would make stuff and get it out to the rigs in the Gulf of Mexico within 48 hours. So anyone that did their planning correctly never had need of our services. But people who were poor planners did have need of our services. And here's the other thing you need to know. The year is 1996. The rental rate on oil rigs at that time for offshore was $250,000 per day. So if someone plans poorly and they're missing the one piece to go into the string to go down into the well to be able to get the oil out of the ground, every day they have to wait for that thing. It's cost them an extra $250,000 minimum because they're also having to pay the crew, they're having to feed them, they're having to do all this sort of stuff. So what does this mean? It means they were motivated buyers, right? They're motivated buyers. If we can get that stuff out there in 2 days, not only can we charge a premium, we can demand cash. So our accounts receivable period was how long? 0. Now the inventory, we never knew what people were going to call in from offshore and ask for. We basically kept very little inventory at all. We had all these steel yards around us that carried the different kinds of steel for offshore work. And so all we had to do was call them up. They would saw off the chunk of metal we desired and they would bring it over. And immediately we would put it on the machine. And so the inventory period for us was basically just the amount of time that that thing was in the shop. And then, so it's in there for 2 days, and then it goes out and we immediately get paid. What's our accounts receivable period? 0. Here's what you need to know though. When we're dealing with the steel yards and they send over that steel, they're giving us 30 days to pay. And so we were actually getting paid on day 2, and we didn't have to pay until day 30. So our cash cycle was actually negative 28 days. Isn't that sweet? Oh, it was a good business to be in. And we would just hope that people would plan poorly because that always meant more business for us, right? And I would have people, and then later on, I got out of the hot shop and I was producing the stuff for the people who planned well. And I would have people call me from the Gulf of Mexico screaming for my product. And I would tell, and by the way, you shouldn't do this, but I'd say, phew, Why didn't you know you were going to need this? Oh, that's not a good question to ask, right? But what kind of prices can I charge? Yeah, if I could save them a day, I'm saving them over $250,000, right? So I could just charge them ridiculous amounts, and they would still be happy as long as I could get it out to the rig. Okay, so does the cash cycle always have to be positive? No. Think about Amazon. When Amazon sells something out of its warehouse, they instantly get the cash, right? Because they're getting it from the credit card company. But what about the people that they're buying all the stuff, and we're talking about the stuff that Amazon owns, not the individual business owners. The stuff that Amazon owns, do you think that they pay cash for that stuff they put in their warehouse? Absolutely not. And in fact, Amazon's so darn big, do you think that they're satisfied with 30-day terms? No, they're probably demanding 45, 60-day payment terms. And by the way, them and Walmart, can they get away with that? Oh yeah, because they're just so freaking huge, right? And so as a result, their cash cycle is probably negative too. Does that make sense? Okay, next time we are going to use information from the balance sheet and the income statement in order to figure out what these periods are, which will allow us to look at any company out there to figure out what is their operating cycle and what is their cash cycle. Any questions? Okay, I'll see you next time.